This week's episode, Tom from Mortgage Tribe joins us. Bit of a resident guest these days, talking about buy-to-let and residential mortgages. Now, Tom's got a couple of real-life examples of what happens if you move abroad and let out your own home, all the pitfalls that you need to look out for and prepare for. As well as that, any changes within the market and a couple of incredible new types of mortgages being launched by the Skipton Building Society. So, take a seat, tune in and listen to myself, Andy and Tom talk this week about mortgages.
Tom, welcome back.
Hello.
Join us for another episode. You're a resident.
Back again.
Back again. Reason why we've brought you back on is because a lot's happening in the mortgage world at the moment. We see a lot of changes, whether that be stress test changes or mortgage rate changes. It seems to be sort of coming from all angles at the moment. And I think with the listeners, they need to know sort of what's going on. You don't always see it in the mainstream media. So it's good to get you on, talk about those changes. So should we sort of kick off with what's happening with rates at the moment for buy-to-let mortgages? Because I've seen some interesting ones come through, some good ones compared to what they were before. But what are you seeing out there at the moment?
Yeah, definitely. It's in a much better position than even when I was last on here, probably about 6 weeks ago. So we're now seeing sub 3% rates with buy-to-let, which is obviously great news for investors. It's not something I thought I'd see this year, to be honest with you, because residential has gone sub 4%, and there was a lot of sort of excitement around that, and buy-to-let has been quite low for quite a while now. But to see it go below 3 is a big shift. Now, like, the fees are slightly high on it, but I did some calculations earlier, and again, if you're looking to purchase over a certain amount, the fees actually do justify going for that rate. So there's always a little bit of T's and C's around what properties and clients it goes for, but it just shows it's all going in the right direction, and some of those fees are coming down. I mean, that one in particular, it's 2.79 is the lowest one at the moment. It does have a 3% fee, but again, it depends on the loan amount. It might be worth doing. And what's really interesting is the gap between 2 and 5 years has really, really increased. So up until recently, 5 years was a lower interest rate. Now the lowest rate I could find this morning for a 5-year buy-to-let was 3.69. So it's nearly 1% difference in 2 and 5, which is huge in the mortgage world. So it's definitely changing quite quickly over the last sort of month, I'd say, which is interesting.
Why do you think that is? Why do you think the rates are better on the buy-to-let side?
Well, with the buy-to-let, I've said before, I think the buy-to-let lenders had such a poor couple of years, sort of in 2022 and 23, that they needed to make up the numbers somehow. But they're just offering those better rates with the higher fee, because I think they're almost willing to take a hit on the interest rate. Like, we're off for that, but as long as people paying the fee, it kind of justifies it to the lender. But and we'll come on to this a little bit later, but there's a lot of going on with the FCA's stress testing as well. We can go into that now if you want, or later on, but that affects more the residential side, but there's still a trickle-down effect to the buy-to-let as well.
Yeah, well, we'll definitely touch on that later on. Do you think that lenders having more confidence in the buy-to-let side of things now? Obviously, we see rental prices increasing. We see the demand still high for rental property, although it's come down a little bit, but it's still high demand there. So do you think lenders are seeing that and saying, well, the risk to
I think the
them
risk is it's much. I don't have the stats in front of me, but I would be very confident on this, that the default rates on buy-to-let is much lower than on residential, because as long as there's a tenant in there, it's kind of washing its own face. It's interest only for a lot of people, so it's just a lower monthly payment to cover. So I think just that is one of the main factors, isn't it? Is the risk element for buy-to-let is lower than, say, a 90% residential mortgage, where someone all of a sudden loses their job, and you're in a bit of bother. So that's probably it in a nutshell, to be honest with you.
And from the sort of landlords that you currently deal with, and obviously you've got this thing of, do I fix in? Do I track it? What do I do? And I think there's a lot of people out there at the moment not knowing what they should do, because they may feel that the mortgage rates will increase or decrease because we've seen a bit of chaos at the moment. So, I mean, what would you sort of advise? Would you look at the tracker? Would you look at the fixed if you're in it for the next sort of 5 to 10 years? What would you do?
I think the trackers are difficult because at the moment they are still quite a bit higher than the fixed rate. So you are banking on the base rate coming down quite a bit to make that work, but they do offer more flexibility. So if you're looking to make bigger overpayments, for example, then the tracker might be the way to go. But just seeing the difference between 2 and 5 at the moment, if you have the right property and the right rental income amount on that property to make the stress testing work, then obviously everyone's individual, but I would be tempted to make hay while the sun shines. Well, just go for that 2-year fix. It's so much lower at the moment than 5-year, and then just review it and see where you're at. But then it always comes down to clients' risk profiles. Well, some people just don't want to pay another product fee again in 2 years, or they just don't want to worry about it. It's like 5 years at 3.8% is actually pretty good money. We'll stick with that for the longer term. So yeah, it's a difficult one, but it's the 5-year. What we're finding, I did a buy-to-let application the other day where I think someone wanted to buy about 500 grand and borrow about 350, a place on the south coast. And in my head, I was thinking the rent's probably going to be quite high to make that work. But for a 5-year fixed rate, they needed £2,100 rental income on that to make it work as far as the lender was concerned. Whereas 2 years, it was quite a bit higher, but I still thought £2,100 is actually not that high for that kind of level of borrowing, I thought. So the stress testing is definitely going in the right direction, and that's helping a lot.
That's what we've struggled with in the south of England over the last few years. The stress test has got further and further away from what's realistic, which led us to have a conversation with Steve from Red Roots, where he was blown away, and he was like, well, my portfolio runs at about 73% loan to value at any one time. Like, he was like, why are you paying 40% deposits? What's the benefit? And I was like, well, there's not a benefit.
There's no benefit.
We just have to.
Just take it or leave it.
Yeah, and he couldn't get his head around it, and I couldn't get I was like, I thought everyone was paying 40% or sort of high deposits, just because that's what was happening in the south. But obviously in the north, he was like, well, I'll just refinance, take my money out and buy another one and keep my portfolio running in the 70s. Which, I don't know, I felt like I'd gone back 15 years by having that conversation. So it's good to hear that those numbers are being relaxed, because it was just getting to a point where, I don't know if it's because house prices took that huge bump for about 18 months or so through COVID and through stamp duty, and now they're flat. Rents are rising slowly but surely now, having had some inflation. Whether that's now reaching a bit more of an equilibrium,
I think so,
naturally, or is it the banks actually manufacturing it?
Well, I think there's definitely an element of that, but a big thing I say a big thing, it's not been made like that public, which surprises me, but the FCA are basically doing a review of the mortgage market at the moment, and the headline is that they are reminding lenders of the flexibility of their rules, which is a massive shift in...
It's not very FCA.
No, it's very not under the FCA. It's, and the lenders have been, I think, quite scared of the FCA for a long time, and the rules are very much open to interpretation, and that's why you do have different lenders who will lend vastly different amounts at different LTVs. So you might have one lender who will lend a lot at 60% and not a lot at 90%, or some lenders' bread and butter is actually we'll make more money at 90%. We're happy to have that risk. And our interpretation of the rules is that we can have a lot of our portfolio at 90% lending, which kind of blows my mind. It should be just the rules are the rules and this is how you go about it. But I guess that creates a bit of competition and allows lenders to have different criteria. So this is happening a lot in residential at the moment, but there's a lot of talk of lenders are changing their stress testing. What that basically means is they're kind of trying to predict, will interest rates increase in the next 5 years? And if so, what's the effect to our clients? And I think the FCA are kind of saying, look, rates have come down a bit. You can actually chill for a bit, to be fair, because I think they think it's going to be quite a stable market for the next few years. So we're seeing a lot of residential lenders who are now lending significantly more. And I think that's having a trickle-down effect to buy-to-let, because not all buy-to-let mortgages are regulated by the FCA, but some are and some aren't. So buy-to-let can kind of almost do what it wants within reason, but they almost set their own risk rules in terms of, let's make sure we're not going to be screwed over.
Yeah.
But with the residential, it's going really, really in the right direction in terms of not forcing people down like 5-year fixed rates. So for 2 or 3 years now, if you want to get absolutely maximise your mortgage borrowing, you've got to do it over 5 years. And I just think it's really unfair to clients. It's fixing them in for, I have to be careful what I say here, but in terms of the way the lenders will basically say, we'll lend you more at 0.5% higher, but they don't feel that you can afford it at 0.5% lower.
Yeah.
That just never has added up to me, and it doesn't seem fair. We're seeing a lot of that getting scrapped. So
yeah, it seemed weighted in the bank's favour, didn't it? That,
and the way
you can have more money if you pay us a higher interest rate.
Yeah.
But at the lower interest rate, you can't afford that.
And they
which will sure it's more affordable at the lower interest
and
rate.
they would sort of hide behind. This is turning scathing, isn't it? But they would sort of hide behind the stress testing. We can, the FCA allow us to borrow or lend more money over 5 years. That's why we're doing it. The fact the interest rate is higher is irrelevant. And I think the FCA are now just reminding them that actually you can lend more money on a 2-year fixed rate if you want to. And they're going through a whole consultation process over May and June, which I think the results will come out in the next few weeks. Will be interesting to see. So a bit more common sense approach, I think, coming from the FCA, which is a real breath of fresh air.
It's a good thing, because it feels from the outside that the banks were potentially taking things out of context to benefit themselves in that sense, because I get why you would potentially loan more at a longer length of a longer period, because there's more guarantees, it's more fixed. In 2 years the mortgage rates might go up, and then you haven't paid down a lot of your equity, and therefore you can't afford it. Whereas over 5 years, well, you're going to pay down a good chunk. You're going to pay down 20% in theory of your equity in that time. And if you're a first-time buyer, you're more likely to be earning more money in 5 years, and. So I can see why the encouragement or the ability to lend more on a 5-year period over a 2, I get that. Very convenient that the rate was higher, isn't it?
Yeah. But there was a period where it wasn't, but now it is very much back to normal in terms of you are paying for longer-term stability, which is, I think, is a fair thing to do. Is like if you want to fix for longer and have stability, then it will cost you. Whereas before it was like, if you want to review this sooner rather than later, then it's going to cost you, which that's just been how it's been for the last few years, really. So, it's definitely a shift in thinking from the FCA, which would be interesting to see.
What's the appetite like in the buy-to-let world at the moment? Are you talking to landlords just renewing their products? Are you hearing from new landlords? Is it all in companies? Where is it at?
A bit of all the above, really. A lot of limited company inquiries these days, just because of the sort of the tax benefits of doing it, and a lot more lenders are coming to the limited company market, so that's creating more competition, because there used to be
the rates were always higher.
Yeah.
It was like, great, I can get the tax benefits,
but
of
the
being
monthly
a limited
payment's
company,
going to be way higher.
The mortgage company's going to rip me off. So,
but because more of them are coming to it, that's definitely creating competition, which is good. We've been talking to a lot of existing landlords who, Andy, we were talking about this before we came on, weren't we? Who, what was it you were saying? Sort of like you got a lot of landlords who are living overseas. Is that right?
For me, a lot of my new clients coming in are moving overseas. That could be Qatar, it could be Dubai, it could be Singapore. And the reason why they're leaving the UK is because they're fed up with all the stuff that's going on in this, and they can move to places like this, and it's they can earn a lot more money than they would do in the UK, and have a better life out in those countries. But for these individuals, this is their family home. That they've got in the UK. They're going overseas for either employment or for the next 4 years. They don't want to get rid of their family home. Because they always want something to potentially come back to if for whatever reason it doesn't work out in those new countries. So I'm getting a lot of people like that at the moment. So for those individuals, we were speaking before about, well, how does that change their sort of, ongoing mortgage for that property? Because when we had the discussion about the other client that we were speaking about, I had no idea that could happen.
Yeah.
I just thought, well, they've got a home in the UK.
What's the
They're
worst?
going overseas for the next 4 years. They won't be treated any differently, and they can just crack on and remortgage as normal. Obviously, you told me differently.
Yeah,
so I
it
was
was the
like,
case.
all right,
Yeah.
okay. Learned
Well,
something
yeah.
new.
So I mean, it's important for people to think about, and I get why you won't think about it. But because obviously at that point you're on a residential mortgage, so depending on which lender you're with, they don't have much appetite for switching that to a buy to let. It was given to them on the provision that it would be a residential mortgage. So what you do is you apply for what's called permission to let with the lender, which they say fine, we can see it will cover the payment, and they will quite often charge either a high admin fee to do it, or they might stick 0.5% on the interest rate, and it's kind of take it or leave it. Again, it's either that or remortgage to a buy to let, but it's going to cost you thousands in early repayment. Yeah, exactly. So the lender, for them, it's a win-win, because they're like, we don't want this lending. It's not what it's intended for, but we're willing to help you.
Yeah.
We're willing to charge you for it.
Exactly. But
great
charge
news.
Out of the kindness.
Yeah. But what happens with these permission to let is when your fixed rate ends, a lot of lenders won't let you choose a new product. And that's exactly what's happened with this client. Is he's being forced to go on standard variable rate plus 0.5%. So he's basically been quoted 8.5%. Take it or leave it. Either do that or remortgage.
Yeah.
So he obviously doesn't want to pay 8.5%. But the problem is he now lives overseas and has done for quite a while. So he's, as far as a mortgage lender is concerned, is an expat. So we're going down the expat mortgage route, because normal buy-to-let lenders won't do it unless you've got evidence that you're back in the UK very frequently, or have a very obvious correspondence address that you're using and coming back, that your family live there. This guy doesn't have any of that. So we've managed to get him about 4.85%, which is not great for his circumstance, but it's a hell of a lot better than 8.5%. It's a much more long-winded application process, but they're willing to do it because it's just a no-brainer. But unfortunately, a lender he's with, which I won't name, they have zero appetite for buy-to-let lending. They don't have a buy-to-let section. They don't offer their products. So I just said to him, unfortunately, you got bang unlucky with the lender.
Begin with a H.
Yeah.
Maybe. There's quite a few that give it a H, to be fair. It's a consonant, not a vowel.
Yeah.
So yeah, that was hopefully a bit of a success story for someone who thought they were going to be absolutely stuck,
Yeah.
and turns out all is not lost.
Well, he saved himself 3% then, right?
Yeah.
So yeah, I think that's and like you said, people that are moving overseas and that want to rent out their property, the last thing that they think of is when it comes up for remortgaging, what is their new rate?
Yeah, so if you've
be?
just fixed for 5 years, you probably haven't got a problem. But if you only have a 2-year fixed rate, you basically got 2 years, and then you have to make a big decision at some point, because the lender, it's in their terms and conditions, this wasn't meant to be a buy-to-let mortgage. We will not offer you a new product. We know it's tenanted, and we don't have any buy-to-let products to offer you.
Yeah.
Therefore, you go on a standard variable rate, or you move elsewhere.
Yeah.
And that's what they're going to do.
Just going back to the limited companies then, because this is another thing that we're seeing a lot of now, is where you've got current landlords maybe shifting their properties into a limited company for, beneficial tax reasons and all of that sort of stuff. So what is the testing that they do if you're applying as a limited company compared to as an individual?
Well, it's weird. So if you're lower of a basic rate taxpayer, they'll lend you more money, because they know that the rent isn't getting taxed at the same amount as someone who is a high rate taxpayer. So they see it the same way with limited companies, that you're getting taxed a corporation tax rate rather than your personal income tax band. So they will lend a little bit more for that reason. And it's why a lot of people are starting to sort of look into it. And I also say, if you've got a good accountant, it's worth, speaking to them, and they can help you out with that. And again, some of the lenders are getting a bit more modern with this. So the Mortgage Works, for example, I can't remember the exact criteria around this, but they will actually let you sell your property to your own limited company, which can save you a lot in stamp duty. So if you want, it's almost like doing the old let to buys, but the big hurdle you have there is stamp duty, because it's a second property, where they will let you, as long as you sort of keep it all in house and do X, Y, and Z, which if anyone wants the information, I can provide it. But they will let you sell it to your own limited company. Therefore, you, in your personal name, don't own two properties on completion, and you avoid the stamp duty charge. So that's quite niche, and that's quite a new thing that they've introduced, which is, again, just a bit more forward thinking, because I think they know more people are going down the limited company route, which is good.
Are there any other sort of mortgage products out there that are being introduced that are new or beneficial to?
I wouldn't say so much on the buy-to-let, but in residential, definitely we're seeing, Skipton, Building Society. They're very sort of forward-thinking. They're doing what they call track record mortgages. So people who have been renting and want to get on the ladder might not have the deposit. That's something that's been coming for a long time. Not a lot of lenders.
It's been announced about 20 times,
hasn't
it?
Really come to
but then when you actually read the terms, it's impossible for anyone who's got two arms and two legs to actually obtain.
Yeah.
Somewhere.
There's a lot of truth in that.
It's like the 99% mortgages and this, that, and the other.
The headline is "We're helping you," but we're not.
It's just
I don't mind admitting it. I've not done one of
Yeah.
those 99% mortgages, and I don't know a mortgage broker who has actually.
Yeah.
And
a track record mortgage, as far as, well, I'm paying £2,000 on my rent every month. Is that a more likely product to actually take wings? The reason I'm asking is I know Skipton also own the biggest estate agency in the UK, so there's absolutely no doubt in my mind they've got better data than anyone else.
Yes, they know.
Yeah,
better than,
exactly.
they've done.
They know rent arrears. They not just from national stats. They've got their own stats. Like of about 250,000 rental units that they're managing.
Yeah, and the other product they brought in, same lender, Skipton. They're doing delayed start mortgages, so you actually don't have to pay a monthly payment for 3 months on it, which I think is actually someone who's maybe come from renting, who's got to give a certain amount of notice or something, and then getting on the ladder. I think that could actually be really useful, and it doesn't seem to be too many drawbacks with it.
Does it roll up the interest?
I must admit, I can't remember how it does. But I always thought it does. But there's no such thing as a free
we
lunch,
all need an 85-inch telly.
We'll need a sofa from DFS. But again, just, I really like Skipton. Just really forward thinking. At least they're doing something rather than just keeping the status quo.
It's good to see, isn't it, that they're doing something different. I don't think we've seen it for a while. I think we've just seen the same generic standard products and approach to things over the last few years, and it's good that they're thinking of new ideas and appealing to more people. And I say trying to help people, but there's probably some sort of caveat in there somewhere. But they're coming up with these products to just be different, and come up with the modern approach to things. Yeah,
and we're seeing a lot of help with first-time buyers. So Nationwide and Halifax have got excellent propositions for first-time buyers now. They'll lend significantly more than what they did, say, a year or two ago. They call it like a helping hand scheme, for example. And to be fair, we've done a lot of them that they do what they say on the tin. So they're not just paying lip service there. So a lot of help with the residential section, but I think with buy-to-lets, apart from more people come to the limited company market, I don't know really what else there is to come, really, except for, maybe in the future helping first-time landlords, because I do get quite a lot of inquiries about people who they don't own a residential property, so they're first-time buyer through and through, but they'd like to just get on the rental ladder.
Yeah, well, that's going to... I've been saying this for about 10 years or longer, obviously because I live in the southeast, like you guys, but when my son gets to the point where he's old enough to own a house, I think he should own a buy-to-let before he owns his own house, because you can just have that washing its face somewhere, rather than moving in and then having an instant $2-3 a month bill, or at least having the ability to rent out the room or whatever it is as having a lodger to sustain it. And I've read articles in the last week saying that's on a massive increase, the amount of people who own buy-to-lets but don't own their own home. Like if you choose to live in London, you're fucked, aren't you? Let's be honest. Like, if you graduate uni or whatever and the job's in London,
good luck.
You're much better buying a property wherever your hometown is, and just having that ticking over.
The reason the lenders haven't done it much is because they call it backdoor residential. Is if you're trying to buy a property that you're personal salary doesn't add up, but you happen to have the deposit, then it's a kind of a loophole and mortgage fraud and all that kind of thing.
Yeah.
But there's NatWest, for example, they advertise it heavily. They do first time buyer buy to let mortgages, but they will assess it on your salary, not the rental income. So basically they're covered. So if you are going to just go and live in it anyway and tell us, we know that actually from a risk point of view, we've made it hard for you basically. So with that criteria, there's no point in lying, because you might as well just go to a residential lender.
That makes it workable for someone who lives in a high value area, but eventually wants their own family home else. I know loads of people who contract, and that takes them anywhere where the money is, but they want a base where they'll eventually settle down. There's loads of industries that kind of has that vibe about it. It's not convenient to own a house where they live or where they work. It's convenient to own a house where eventually they'll settle down, or just have it as an investment so they don't get left behind.
Sounds like an 18th birthday present for Miles then coming up.
Good luck. Yeah.
Send him my way.
But I mean, I've had clients in the army who have buy-to-lets because they're like, I'm going to get kicked out of the army at some point.
Yeah.
And at what point do I do something? They don't own their own residential. They were living in army accommodation, but buying apartments and houses because otherwise, when they get kicked out, I'll say kicked out, but you know what I mean? Like when they get discharged, then they're going to have to start again.
Yeah.
With no salary and a new career. Like they're much better off buying when they're stable and just having it rented out for 10 years, surely. That's that kind of product. That's my biggest thing.
That's the only thing I could see coming in that's sort of new that could revolutionise things a little bit with the buy-to-let market. So it'd be good if more lenders do what NatWest are doing.
Yeah, I think we've seen that we've seen better rates for buy-to-let mortgages. So look, as long as we keep seeing that, there's going to be more appetite for people to come in. And those just on those rates that we're currently seeing, sub 3%, they were on a 75% LTV as well, weren't they?
No, 50.
50.
So it is very much at the so you've got
to have a hefty deposit. Yeah. All right, some people can make that work, but we might get to a point that look, if we keep seeing them dropping down, then maybe we see that 75% LTV one come down to around 3%.
I mean, 75% LTVs are still, very. From my point of view, very competitive. It's still sort of 3.6 or 3.7, so it's still lower than a residential. So, it can be the barrier is getting the deposit, but if you are in that position, it's still cheap money in this day and age.
Yeah, I think that's where we're going to see new investors coming into the market, because as Mike said, his boy, when he gets to that age and wants to get his buy to let, then he's probably not going to have a 50% deposit for that property, but he might have 25 if Mike's kind to him and then gives him a bit of money. But I think for the younger people coming in, I think you've got to try and make it work.
There's a massive amount, like probably people older than us, who are trying to find ways, are finding ways of gifting money, because obviously the whole pensions as part of your estate thing has been destroyed. So I think over the next 2 years or so, there'll be more money passed down from the grey-haired generations to the kind of people who are having kids generation. I don't know, there's probably an actual phrase for that. But you know what I mean. Yeah, the retirees down to the families than ever before, because I just know that from our guys at Soteria. I know that from my family, that both my parents and my in-laws are both retired, and they're looking at their finances going, well, we were set up a minute ago, and now if I pass away, the inheritance tax bill is absolutely disgraceful, so I'm going to have to destroy what I've set up and move the money. So there'll be more of that money coming down, and at that point, if maybe you've got an older pet, I've got friends who are doing the whole second family thing. Well, why not put that money into your child's name and buy them a buy-to-let property, because they're not going to buy a residential property age 18 and move into it. Like, that would be carnage.
It comes down to education as well, isn't it? Can we teach the younger generation from who are in school now to be a bit more financially savvy, because you're going to need to be, because it ain't getting any easier for that generation. And I think, wasn't it, Mike, a couple of years ago, you went to a school, didn't you? And like, they were
done it a few
fascinated
times
by stuff that you had to say. And I was like, it's kind of stuff they're not being taught, I imagine, in the curriculum. But the minute you hit 18, if you can teach someone, actually, if you do X, Y, and Z, this is what a mortgage is, this is what buy-to-let means, this is what tax means, this is what a payslip is, you can get people on the right foot straight away. And little things like, this is what a credit score is. Don't put all your trainers on Klarna from day one, because it will come back to bite you at some point.
And it's funny you say that, because I said a couple
you
of weeks
all your trainers
ago,
on Klarna, didn't you?
But I said a couple of weeks ago, I was talking about, I was doing a lettings course with our apprentices, and when I was talking about credit score, not one of them knew what it was, or checked their credit score or anything like that. And it's like, look, I know you're young, but you need to know what it is, and how that is basically your CV for further on when you want to buy somewhere, or you want to get a loan, or you want to get a credit card, you want to do all of these things. That is your CV. That's
financial literacy. We've had it with our business in the last 12 months. We've bought a commercial building, and when I first applied for the mortgage, they went through me with a fine tooth comb. Then there was a massive delay on it because there was a tenancy involved and blah, 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 all very boring. I went to reapply, and we'd filed a second set of accounts, and we'd used Amex and all sorts in the previous year, and it went through so fast. Because she was like, what happened? Your credit score is like an international A. Like, because our shareholder funds had gone up, because the cash in the account had gone up, because we'd used credit, utilised credit, we'd done everything that we tell people we should do in our company, almost sort of not by accident, but by some careful financial management, without really thinking about why we were doing it. We're just doing it for the right reasons. And they were just like, yeah, okay, no, we'll have it approved by the end of the day, no problem. But people just don't. Teachers aren't the people who should be teaching it. To be completely honest, they're no. It's not their job. It's the job of people who understand it to get in front of them, to tell people exactly what you're saying is. But this is the X, Y, and Z. Because when I was sat in front of like a group of teenagers, this is the difference between having a mortgage and renting. Now, I understand the benefit. Sometimes there's a benefit to renting in that you don't have to put a huge deposit down. But if you buy a house at the age of 30, by the age of 60, realistically, it is yours. If you rent a house at the age of 30 and you're still living it at 60, this is how much money you've given away. And what then? Like, unless you have an inheritance event, you're in all kinds of trouble. And that's what people that's what really made them go, wow, like, that's a really weird system. Like, you're seeing it from, like, it's like you just taught them something totally, and they're like, that is weird.
Yeah, but and also if you're talking to, say, 18-year-olds, people who are old enough to sort of put things on, I just hope there's not like a ticking time bomb with some of this stuff where, people need to be taught. If you do buy stuff and stick it on Klarna and whatnot, and you all of a sudden forget, because everyone makes mistakes. Oh, I forgot to pay that. That will go down as a missed payment on your credit file. And you might not care at 18, but when you're 26, 27, and you might start caring. It's like that really sort of Black Mirror sort of thing I saw in America, where I think DoorDash, which is like the equivalent of Deliveroo, they've teamed up with Klarna, I think, where you can buy a meal.
You can do it.
Can you do it here?
Yeah, you can do it on Just Eat. You can do it on Deliveroo. That's like, you can pay by Klarna. So spread it over 3 months. That scares me. Spread 40 quid.
I mean, that is Black Mirror shit if I ever saw it. But like,
it's just weird. But like, why? I'm in the wrong generation for that.
That could be so easy. Like, I'm sorry, I can't get a mortgage because you forgot to pay for a pizza 6 weeks ago. Like that's worrying.
Like, if is it that, like, I guess it's like, if it's that tight on the 28th of the month that you can't buy a takeaway, don't buy the takeaway. I don't like to sound like the old guy who's like, don't go to Costa's.
Rob Moore,
buy a house.
Rob Moore talks about it a lot. If you look at
he's a big fan of Klarna.
If you look at his social media account, he absolutely slated Klarna because it was literally like, this is what we're doing to the younger generation.
Absolutely.
You can go into Claire's Accessories, you can go into other shops, there'll be a big sign there saying Klarna. And then, so when you're young and you think, oh, actually I can pay that over 3 months, or I can pay it within 30 days, I won't bother about it now, I really want it now. I haven't got the money now, so I'll just take it and pay within 30 days or over 3 months. And there is no limit to what that transaction is. It could be £5, it could be £1,000.
Well,
so
it's just on tick, isn't it? Like,
it's basically on tick. That's it. So back to the younger days.
Yeah. Well, again, I mean, we could be here all day talking about this, but it's now everyone wants everything now in this generation. You know, no one waits for, the next even TV shows come out because you can just binge it all in one go. It's just like no one. Again, we sound like old men.
Yeah, I was fuming when Clarkson's Farm, they split it up. Like, 2 episodes a week. I was like,
just want it now.
Get Jeff on the phone.
Yeah, but people don't. Maybe kids don't save up like they used to. If you want something, put your pocket money away for 3 months, then you buy it. Whereas now, just stick it on Klarna. But
it's crazy. Anyway, we've gone away from this all of a sudden. We've slated Klarna.
I don't think their results are doing too well. By the way, I had a little look the other day, and
let's see what that does on the socials.
Clouds ahead.
Yeah. Tom, thanks for coming on again.
That's right. Thanks for having me, guys.
Always love it when you come on and give sort of the insights to the mortgage world, what's going on, what the changes are. So thank you for that. Listeners, Tom's contact details will be in the show notes. If you want to reach out to him to get any advice to do with mortgages, then feel free. Happy to help anytime. But Tom, thank you.
Thanks very much, guys.
Thank you. And we'll see you for the next episode.